Okay, so I want to talk about what private lending is. So, private lending is lending by individuals or other private entities providing, and they're providing mortgages to borrowers. Typically, they're for borrowers who are unable to qualify for traditional mortgages from institutions. So, that would be from A or B lenders. Private lending is there to be a temporary option for 1 to 2 years. You must have a clear exit strategy for private lending. These are not long-term solutions. They're going to be mostly based on the value of the home versus other factors, which we'll go into a little bit more later. So it's going to be based on loan to value versus credit or income. And then typically it's going to be a 1 year term interest only. So reasons your client would need a private loan. One would be to consolidate debts, pay collections, or increase credit score. This is going to be for clients who, maybe their credit is lower or too low for a traditional institution to lend on, or they have previous bankruptcies, consumer proposal, that sort of thing. And an institution has deemed that their credit score is too low or the history is too bad. Private lending would be a good option. Another reason would be to save their home from power of sale or foreclosure. So if your client has missed any mortgage payments, and the bank is now, called their loan and are threatening power of sale or foreclosure, placing them into a private mortgage that's possibly prepaid in order to pay out that loan that's been called that they're threatening power of sale on to save their property. Another reason would be construction. So a property that your clients bought some vacant land and they're looking to build a home on it, or if they've bought a house that's not necessarily suitable to be lived in at the time, most traditional lenders won't touch that. So private is a good way to go for construction loans. A bridge loan or something very short term private loans, you can get them open, you can get them for 3 to 6 months closed, or even if it's just required for a few days, private can be a good way to go for a bridge loan. If your client has unstable or unverifiable income, they've just started in a self-employed industry or they've been unemployed for a certain amount of time, but they have savings. If they make a good amount of money, but they don't claim it on their taxes, if you can just show it through bank statements, private would be a good avenue for them. Another option is if your client does not have enough income to service the debt, through traditional means, but they have a lot of equity in the property, you can do prepayment on the loan. Unique properties, so historical properties, rural properties, things that a bank wouldn't necessarily touch due to condition or just the type of property that it is. If a higher loan to value is required, so say your client needs a second mortgage that goes up to 85%, that's not something that a traditional lender is going to touch, but private lenders will sometimes go above that 80% threshold. And then another reason would be funds are required quickly. Say your client has an emergency or, they find a property that they really want to put a deposit down on and they require those funds, within 24 to 48 hours. Private loans can fund very, very quickly, a lot faster than a traditional institution, which, usually takes a couple weeks at minimum. So private is a good way to go for that. So there are a few different types of private lenders I wanted to review. Individuals, so these are going to typically be high net worth individuals with their own lending portfolio. This is somebody that you usually have an existing relationship with. FSRA wants everybody, to do their due diligence when they're dealing with individual borrowers. You want to find out where their funds are coming from. You want to make sure that they're financially stable themselves in order to make in order to lend on the property. They want you to ensure that your investor has good knowledge of, real estate transactions, of private lending, what the risks and the benefits are. So, that is up to you to do that due diligence when you're dealing with an individual. The next type of private lender is going to be a MIC. So it's a mortgage investment corporation. It's a company that allows individuals to invest into a pool of mortgages. They can also borrow funds from banks or other lenders. So some MICs, can be funded by Scotiabank or RBC or BMO or whatever. But they also typically have, a bunch of investors that are pooling their funds. It's a lot more secure for investors because you're not invested in one specific property. The lender is going to pay you a fixed rate of return regardless of whether, their mortgage has gone into power of sale. You're going to get that you're going to get that return, you're going to get those payments from that MIC, regardless of what's actually happening with the funds. I know Kingsdale's working on opening a MIC, which is a really great resource. I prefer to use MICs on the private side. They've got good rates, they've got good funding, and they're typically really easy to work with, in my opinion. The next would be syndicate. So that is several individuals combining funds for one registered mortgage. So instead of a MIC where everybody's pooling their funds to be pulled from at the decision of the MIC, a syndicate is just multiple individuals for one loan specifically. They each pull in $100,000, $200,000 for one loan. Syndicates you often see with mortgage administrators, I find. The mortgage administrator is obviously somebody who deals, basically does the administrative work of the loan for the private individuals. There are other types of private lenders, vendors, trust companies, and pension funds. These are, you usually don't deal directly with them. They may be part of a syndicate or part of a MIC, but it's not something that you often see or that you would often deal with as an agent. So it's pretty much individuals, MICs, and syndicate lenders that you're going to see more often than anything else. So on the borrower side, there are obviously benefits and risks along with the lender side. So creative underwriting, that can be, things like blanket mortgages, stated income, low or no document verification. Again, quick turnaround time. They can fund within 24 hours, sometimes, same day, depending on the lender that you go to. They are very flexible, so shorter terms, open terms. You have the option of prepayment if you don't have the funds to service the mortgage, as well as, a lot of private lenders do offer renewal if, as long as the client has made all of the payments within their original term. It also allows borrowers to deal with the credit and debt issues that are preventing them from borrowing on the institutional side. Obviously, there are risks when it comes to having a private mortgage. The biggest one, being the rates and fees are significantly higher than on the A or the B side, particularly the fees. Also, if you do end up needing to renew the private mortgage, renewal fees can be quite costly. Some lenders is the 1% fee. Some lenders, they have a minimum renewal fee of say $5,000. So even if your second mortgage is only $100,000, they're going to charge you a 5% fee to renew. Private lenders are not protected or insured by the government. They're not they're very lightly regulated by the government. So you don't have the protections that you would from an institutional lender. And then obviously as the borrower, you would be taking, a risk with economic changes that would prevent your exit strategy. That could be rates increasing. There were a lot of people who took private mortgages during the pandemic when when property values were very high and rates were very low. And then they try and exit the next year and their property value has gone down significantly. The rates have gone up. They may have lost their job because of the way that the economy's kind of gone. So it is very risky taking a private mortgage as a borrower, and there needs to be a clear, doable exit strategy that's outlined. For lenders, obviously the biggest benefit is higher returns. They can charge much higher interest rates than you would expect to return with a lot of investments, as well as you receive an upfront fee. Pooled funds, again, this comes from MIC, where it's your funds aren't put into one single property. They're pooled into a fund and basically placed into multiple properties, so you have more security. The lender also has the benefit of being able to power of sale a property to recover the funds, meaning that they can essentially force the sale to recover. They can also foreclose on properties, but it is much less common because it's a court supervised process versus power of sale, which is not. And then they have the predictable returns and consistent cash flow. As long as the borrower is making their payments on a monthly basis, it can be assumed that they're going to get a specific monthly amount back every payment, and that cash flow is going to be consistent. The biggest risks in private mortgages are for the lender when it comes to borrower default. There still is a lot of risk with taking, these clients that have been declined by traditional institutions. A lot of the time, there is default on the private mortgage side. The next one would be borrower repayment at the end of the term, whether or not your borrower is able to actually pay out that private mortgage. A lot of the time, borrowers being unable to repay the private loan, they can't refinance, their property value is dropped, they're unable to get an approval from somewhere else, because their circumstances have gotten even worse. You're forced to power of sale of property. If you are relying on those funds, you have to make sure you have a backup plan. So that's a huge risk. And then obviously the other one is market fluctuations. Again, if the property value drops and you've lent up to 80% and you see a 25%, 20% reduction in value, then you are way, way over leveraged on the property that you've now lent on. So your role as an agent when it comes to a private transaction does differ a little bit depending on, who you're representing in the transaction. Working for the borrower means that you're only working in interest of the borrower. This is typically seen when, you've engaged another agent and they're representing the lender in that transaction. You're representing the borrower and everybody is kind of charging a fee. This mostly happens when it's an individual lender that you're dealing with. Your role is to represent the interests of the borrower only. You're not looking out for the interests of the lender. Again, the opposite end of the spectrum, you are representing the lender only. You have the private connections and you have agents coming to you with deals that you're vetting for your lender. You're not acting as an administrator because the lender has full control over the deal. It's their name going on the mortgage, but you are, acting in interest of the lender. The most common one would be acting for the lender and the borrower. This is when you're dealing with a MIC, or a mortgage administrator. So you have to make sure that you are disclosing any conflicts and you're making sure that both parties are being treated fairly. And then the third role would be if you have an administrator's license, you can act as an administrator for a lender. So you would be the one receiving payment by the borrower and making the payments to the investor. You are going to be monitoring the borrower, making sure that they're making the payments on time, making their property tax payments, and that their exit is still lined up properly. So there are a lot of companies out there that act as administrators. So you'll see that they have the commitment letter white labeled, but they have the actual lender's name on the commitment and they're the one that registers the charge on the property. But you are administrating the loan for them. If there's any default, you're the one that deals with it. If there's any power of sale, you would be the one that deals with it. You have to have a license to act as an administrator, but it is something that a lot of people do, especially when they have a significant amount of private connections, because it does give you a little bit more protection, and it protects the lender a little bit more as well. So obviously, regulatory stuff has changed a lot in the last year with the introduction of the level 1 and level 2. Level 1 agents cannot broker private mortgages. FSRA will fine you or they'll take your license away if you're caught doing it. You must work with a level 2 agent to broker a private loan. So that doesn't mean that you can't talk to your client, but the level 2 agent is the one that has to provide that private mortgage advice. They have to review the documents with the client. You can shadow a level 2 agent or your principal broker, who obviously would be a level 2 agent for private loans. From all of the MICs and administrators I've spoken with, you can submit with your principal broker or the level 2 agent as the submission agent, but you can still be the contact on the deal as long as that level 2 agent is involved in the process. So they're CC'd on the emails or whatever. And if there's any advice that's being given out, it does have to be coming from the level 2. So just be careful with that. You don't have to fully back out of the deal when it comes to a private mortgage, but you do need to make sure that you're protecting your license, because if they do catch you, it is at minimum, I think it's a $10,000 fine at minimum. So you just want to be careful with that. The next big thing is disclosures. So there's multiple disclosures that have to be presented, especially when dealing with a private individual, to the borrower and the lender. So to the lender, you would be filling out a Form 1. That is basically disclosing all the material risks to the lender. And then obviously you're making the disclosure to the borrower. The disclosures have to be written in plain language. So that means easy to understand by the average person who doesn't, know mortgage lingo. It has to be made in writing. You can't disclose anything on the phone. You can't disclose anything, over text. It has to be in an official document. Has to be signed, presented at the earliest opportunity. So they say at minimum 2 days before the transaction closes. Obviously, when things close within 24 hours, there are waivers that can be signed to, remove that 2-day minimum. All fees have to be included in these disclosures, including estimated fees. So that's your legal fee estimate, your appraisal estimate, which we went over looking at compliance documents in previous training sessions. And then you also have to indicate prepayment costs. You also must disclose any conflict of interest to both parties. That can include if you're being paid a referral fee, if you have a familial or other relationship or an existing business relationship. If you take all of your private clients to the same lender, or to the same 2 or 3 lenders, you must disclose that you have an existing business relationship and you work together frequently, because it is a conflict of interest. In my opinion, the final most important thing is suitability. So this is going to protect you from being sued or from losing a lawsuit if somebody decides that, or from being fined from FSRA or getting in trouble if somebody decides that they actually think that they should have qualified with an A lender or a B lender, but you put them in a private mortgage. Suitability is ensuring that the client's suitable for the mortgage that you've placed them in. You want to make notes as to why they needed to go private, why the chosen option is the best for them, and what their exit strategy is. So, if the client has terrible credit and can't be approved by an A lender, you put them with this lender because they're offering a good interest rate, and a lower fee than this other lender, and then what their exit strategy is. You want to sign your note, include the client name, the client address, and then you want to have the client sign that as well. That one document could completely prevent you from, getting fined by FSRA or, getting sued for putting somebody in a private mortgage when, they feel like they were screwed out of it. So it's very, very important to make notes regarding the suitability of your client to the mortgage that you're placing them into. Again, another thing this has to do with suitability that's very, very important is planning the exit strategy. So how is your client going to get out of the private mortgage by the end of the term, or, within 1 to 2 years? Like I said in the beginning, private mortgages are short-term solutions for a long-term problem, which would be having a mortgage. So you need to make sure that there is a clear and realistic plan from the start, from the beginning. The biggest thing, people send you a deal. They say, hey, this person wants, 500,000 second. You say, okay, what's the exit and why? Why do they need to go private, and what's their exit strategy? You need to make sure that the strategy aligns with the term of the private mortgage. So, if your client thinks that they're going to improve their credit within 6 months, but that's not the case. It's going to take at least a year for them to improve their credit, to a score where the institutional side would even consider looking at it. Then you need to make sure that you're putting your client in a term that's long enough for that increase to be feasible. The next one would be to consider market conditions. So the current and projected market conditions that might impact the exit strategy. This is especially important for sales and refinancing. So if your client's exit strategy is to sell the property, but you have a feeling that property values are likely going to stay the same or they're going to decrease, then this is not a feasible exit strategy. But if that it's likely that interest rates are going to come down, property value is going to increase a little bit again, then yes, it can be a feasible exit strategy. And then obviously communication. So once you've placed them within that loan, if the client is going to, if the client's committed to getting a second job, or if they've committed to not using their credit cards anymore, you need to regularly communicate with the borrower and the lender about the progress of the exit strategy. If we're now halfway through the term of the loan and the client's credit hasn't improved at all, you need to make sure that you're communicating that to the lender, that the exit may not happen within 6 months, and be prepared for your next steps. If you need to refinance them with another private lender, if you need to, get on top of your client to actually take the steps in order to, work towards that exit strategy, or if you need to prepare your lender for renewal, that they're not going to get their funds back at the end of the term. You just need to make sure that everybody's on the same page and make sure that everybody's, given enough time to prepare for the end of the term. So we'll go over a couple examples of exit strategy. So the first one is refinancing with a traditional mortgage. Borrower refinances the private mortgage by obtaining a conventional mortgage from an A or B lender. This is suitable once the borrower improves their credit worthiness or stabilizes income, which then would make them eligible for a traditional mortgage. Next one is sale of the property. So the borrower sells the properties that's secured by the private mortgage. This is common in like a fix and flip scenario or when the borrower anticipates a significant increase in the property's value. It's also common when the borrower is trying to save the property from power of sale or foreclosure. Using proceeds from business operations or investments. So the borrower uses profits from their business or other investments to pay off the loan. This can be suitable for things like commercial real estate loans or when the borrower has a business generating sufficient cash flow. They have to make sure, and this is again on the communication, that that the client is allocating the business profits or investment returns so that they can pay down or pay off the mortgage. And then asset liquidation, this would be, the borrower selling other assets to generate the funds needed to pay off the mortgage. This is suitable when the borrower owns other valuable assets that can be liquidated, such as stocks, secondary property, valuable personal items, and then the proceeds of those assets go to repay the mortgage. Common policies with private lenders. So maximum loan to value is going to be anywhere from 65 to 75%, depending on the lender. Higher value or higher loan to values are possible when you do a first and a second mortgage. You could do a first up to 65, a second up to 85. Previously during the pandemic, we were seeing loan to values around 90%, even up to 93, 94%. And now 80% is kind of where a lot of lenders are maxing out. Sometimes you can get a second to 85, but the rates are going to be significantly higher. The fees are going to be significantly higher, and you really need to prove, that the borrower can service the mortgage. Rates start usually around 7.5% for first mortgage and can go upwards of 17% for seconds. Again, it really depends on the lender. Fees typically are also going to start at 2% on the lender side, can go all the way up to 4 or 5%. Broker fee is typically 2%. Sometimes less, sometimes more. Again, it depends on how much work you're putting in to get the client approved, what the lender's charging. Sometimes you can get away with charging 1% and having the lender add 1% to their fee for you. But again, everything has to be properly disclosed to the client, and you need to make sure that whatever you're charging is ethical. Ethical is obviously tough to give you a definition of, but if the lender's charging 2%, it is not ethical for the broker to charge 5%. You are not going to get in trouble for charging an exorbitant fee. You may get a slap on the wrist from FSRA, but you need to make sure that you're following industry standards based on the amount of work that you've put in, and what is typical for people to charge. Terms most commonly is 12-month closed. A 6-month closed, 6-month open is getting more common with a lot of private lenders due to higher demand. Typically, the term is going to be 12 months closed, interest only. It's very, very rare that you find a private mortgage that's amortized. If it is amortized, it's typically over 40 years, because if you're paying down principal and you're paying the interest for these super high rates, the payment is going to be very, very high. They are compounded monthly, so it's very, very easy to figure out what your monthly payment is. You multiply the loan amount by the interest rate, and then divide that by 12 to get your monthly payment. Super simple. Documentation is really going to have an effect on the rate that you receive. There are, obviously programs for full income verification, whether that's, letter of employment, pay stubs, bank statements, financial statements, T1 generals, all that. That's going to get you the best, lowest rate, fully verifiable income. Kind of mid-range is you're going to be low doc, or as some lenders call it, reasonable evidence of historical employment. So that's basically, some more recent proof that you have had a job. So that's like a T4 from, 2023, or, a bank statement from last month showing that you had a pay deposit in your account. Could be a single pay stub, but it's very low doc, just any sort of proof that you probably have a job. And then no doc or fully stated income. So some lenders will basically take your word for it, or they will lend simply based on the loan to value. This is where your loan to value is likely going to be 65% or lower if it's a no doc deal. Fully stated can be your client is self-employed and they simply fill out a form that says, I, run a construction company. I've done this for 5 years and I make $150,000. They sign it with us. They sign it with the lawyer. And those are going to be your highest rates, typically a rate premium of 0.5% to 1% on top of the minimum rate for those low doc or no doc programs. So you're going to probably hear when you do start doing private loans, or you have heard people complaining about the documents that you're asking for. Private loans have changed a lot in the last 2 to 3 years. Especially when it comes to appraisals and documents required. 4 years ago, you could get a 80% loan to value second mortgage with an appraisal that was done a year ago. Maybe a pay stub, maybe not, and probably not a credit report. It was very simple, based on equity. Didn't really care about the serviceability of the loan because everybody knew that property prices are slowly increasing. The economy's okay. So it was very, very simple to get a private mortgage. Over the last 2 years, things have really changed, especially when it comes to what I've seen is credit reports and appraisals. So anytime you deal with a MIC or a mortgage administrator, they will want a recent addressed appraisal. So that would be within the last 30 to 60 days, and addressed means that they can legally rely on the appraisal. So that appraiser is going to either give you a letter of transmittal, or they're going to directly address that appraisal to the lender, and the lender is legally relying on that appraisal to verify the value of the property. No more will people take an appraisal at face value, look at it, could be 3 months old, directed to RBC, as long as the value is there, they don't care. If you're dealing with any sort of corporation, MIC, administrator, whatever, they're going to want an appraisal within, at minimum, the last 60 days, maybe 90 days if you're lucky. And they're going to want it addressed to them. Credit reports, even with individuals, are now required 99% of the time. They want to know what their credit score is. They want to know if they've missed mortgage payments, if they want to know if they've missed just personal revolving debt payments. They want to look at the credit score. It's also another factor of them verifying the client's identity too. And then lenders want to know how the client will service the debt. Some of them may want full doc verification, so they may want letter of employment, pay stub. Some of them might just want a notice of assessment so they can see the total income and they can see that the client doesn't have significant tax arrears. Because if a client has a lot of outstanding taxes, eventually the CRA is going to register that on title of the property, and that is no good for mortgages. So depending on what type of lender you go to, typically they want some sort of income verification. Even private individuals now are looking for income doc verification. So things are definitely changing. A story is important. So, I was talking with Alona about this last week, and we're like, what's wrong with the deal? Why is your client going private? Like, what's the story here? Because nobody wants to, spend hours and hours digging through the deal and realizing, oh, okay, well, this is why nobody's touching this deal. What's the story? How did they get into this situation? And why are they here? Again, exit strategy, it has to be something that makes sense. Your client is not very likely to, get a second mortgage up to 85% and expect the property value to increase enough to refinance with a traditional lender next year. With the way that the real estate market is working, it just doesn't happen anymore. So it needs to be an exit strategy that makes sense. And then something that, if your client has had private mortgages before, if you're dealing with, a realtor that says, oh, I used to get private mortgages and all they wanted was, an estimate from, a realtor 5, 6 years ago. It's not the way that it works anymore. Some private lenders want as many documents as an A lender or a B lender, especially with higher loan to values, especially with clients who have poor credit. It's just the way that it is now. Private lending has changed a lot, and I think we're going to see it change even more in the next few years. I think it's probably going to be more heavily regulated, but because of the amount of private lenders that and private borrowers that their lives were kind of messed up because of how the real estate market has changed in the last few years with the incredible increase in values and then the significant decrease in values. I think that we're going to see even more changes, and private lending is going to get even more difficult over the next few years. Okay, so I just want to go over some scenarios with you guys so you can kind of see a couple borrowers that would, fit well with private lending. And then afterwards, we can do any questions that you guys have. So this borrower has poor credit, so below 600 with missed payments and collections due to job loss. They have $125,000 in debts that need to be paid off. Most are consumer debts, credit cards, lines of credit, personal loans. So I can't see here. So remember this analogy that we did previously with the stool. In order for your borrower to qualify with an A or B lender, at least two legs of the stool have to be solid. And sometimes you can get away with one of them being less so. This borrower, essentially, two legs of the stool are not very solid. So the credit and the income, and then the property is the strong leg. So their income, they've been out of work for 2 years, which is why they've been relying on their consumer debts, the credit cards, lines of credit. But they've just recently started a new job last month, and they're going to be on probation until July. So this isn't income that an A lender or sometimes even a B lender is going to accept until they're off of probation. And their new income will be enough to service the mortgage payments. The property is a single detached home in a marketable area. It's worth $600,000, and their current institutional mortgage is $300,000, and it's in good standing. So they have not missed any payments on their first mortgage. So because their first mortgage is in good standing, the lender is not asking them to pay it out. We can assume that they have a pretty good interest rate on it. We're going to keep that mortgage where it is, and we're going to request a second mortgage. The debts total $125,000, so we're going to add in some additional funds to make sure that the client can cover any, appraisal fees, lender fees, broker fees, legal fees on top of the mortgage request. So our loan to value is going to be 75%. Everybody knows how to calculate loan to value, hopefully. Does anybody not know how to calculate loan to value? Okay, I'm just going to assume everybody does then. And because the client's credit, is below 600, we want to give them a year for their credit score to improve, as well as to show an A lender or a B lender that they do have significant job stability now. They'll be over a year at this new job that they've started. So regardless of being unemployed for the last 2 years, they'll have over a year of solid employment history, which is going to make them, a lot easier to move back to an institutional lender. So our exit strategy is once the client has improved their credit and job stability, they will refinance with a traditional lender. All of that makes perfect sense. And this is exactly what a lender is going to want to know. What's the credit? What's the income? And then what's the value of the property? So our exit at the end of this, we're going to refinance. We're going to pay out the first mortgage, and we're going to pay out the second mortgage. We're going to consolidate into one mortgage for $450 with probably not an A lender because we'll only be 1 year out of the poor credit. But with a B lender, it's definitely going to be more likely to work. They're not going to get, a 3 or 4% interest rate, but they're going to get something in the 6 to 7%, which is going to be significantly better than, the private interest rate for a second mortgage. They're going to pay at minimum like 9.99%. That makes sense, everybody? Okay, we're going to scenario 2. So this credit, 2 clients have reasonable credit in the 650 range with no missed payments or collections. They have high utilization on some revolving debt, so credit cards, lines of credit, and then multiple high car loans. They're realtors. I know realtors love their BMW, so I just threw that in there. Income, they have multiple income streams, including rental income, investment income, and they're both real estate agents. Most of their income is not verifiable by traditional means, meaning that, these are realtors, they have a personal real estate corporation. Into the corporation, they might get, $1 million a year each, but they only pay themselves, $50,000 a year. They don't claim their rental income. So none of it is verifiable by traditional means, but it is verifiable, through bank statements, stated income. The borrowers are buying a $2 million multi-unit apartment building in need of major renovation and repairs, about $500,000 worth of renovations. They intend to renovate the property to make it ready for new renters. They also have an additional property with collateral that's worth $1.5 million and has a mortgage of $500,000. So there's $1 million of equity in there. So they have the $500,000 that they need to do the renovation. So they are looking to finance um, the full $2 million. Well, wait. Actually, they want to finance the whole thing. They want to finance the $2 million and the $500,000. No, the first thing I said, they have the $500,000 that they need to renovate. They're looking to finance the full $2 million. So in order to calculate the loan to value, obviously we're going to add up the requested loan amount for the new property and the existing loan amount on the existing property. And you're going to divide that by the property value. They're buying the property for $2 million, it's worth $2 million. And the value of the collateral property is 1.5 million. So that's going to give a 71% loan to value. So it's going to be a blanket or a collateral mortgage. It's going to be a first mortgage on the property they're buying and a second mortgage on the collateral property. So the clients think that they can get the renovations and repairs done in 6 months. So we're going to do a 6 months close, 6 months open. It's important to not do just a 6 months close term in case they do go over time, which, often happens with construction. So we're going to do 6 months closed, 6 months open, interest only loan. If the lender was open to it, we could also increase the loan to value and fully prepay the mortgage for that first 6 months. So they would calculate what 6 months of the monthly payments would be, and they would add that onto the loan amount. So the borrower's not making any actual payments for the first 6 months. Our exit strategy that the borrower has had as a complete appraisal done. So they've, showed an appraiser what the plans are for the completed property, and the appraiser has valued the completed property at 3.5 million. They anticipate the value to increase that much. And once the renovations are done, they are going to sell on completion. So they'll pay out that mortgage, and then they will have, they'll make the profit there. So that's kind of all I wanted to go over with you guys in terms of private mortgages. Again, it's not something that you guys will actually be able to do until you get your level 2. But it is really important, when you are evaluating a client, to know whether or not they're going to qualify for a private mortgage. And then, if they can't necessarily get an A or a B, then you're not just saying, no, sorry, there's nothing that we can do for you. And when you're referring, this deal to a level 2 agent, that you already have a summary of the loan, you have the answers to all the questions that would need to be asked. You have your exit strategy prepared already. So all you need to do is find somebody who can essentially broker the deal for you. Questions from anybody?
Hi, Jenna.
Hi.
Yeah, so in terms of the private mortgage, is there like a minimum loan, most makes issue out, or is there like a maximum in terms of like the compared to like the what's it called, the price of the asset?
So there's no, it's going to be based on, individuals. You're
Mhm.
probably going to have an easier time getting a loan amount under $50,000 from an individual lender versus a MIC. The more corporate ones, so MICs and administrators may have a minimum loan amount, but I've seen mortgage administrators do a second for like $15,000-$20,000 before.
Okay.
So there really is there's no legislated or minimum in any regulations. In terms of maximum, most will do, well, not most, some will do up to 50 million. Some of them max out, around 2 to 3 million. It really depends on the funding that they have, because, a lot of MICs and administrators are funded by individual investors versus banks. A lot don't loan over, $2 or $3 million for each mortgage. But there may be, there are lots of MICs out there that do have, financial backing from big banks and do lend significantly higher amounts.
Okay. Thanks.
There's just a question in the chat here. So for private mortgages, can clients pay off any time or will there be a penalty? Typically, if you are within the closed portion of the mortgage, so if it's within a 12-month closed term and they want to pay it off after 6 months, there is a 3-month interest penalty. That's the most standard. It works the same way as any mortgage. If it's closed, there's a penalty. If it's open, there is no penalty. 3 months interest is the standard amount. Any other questions?
Hey, Jenna, the private mortgages, can we still use Finmo and do all of our documents and all that through there to keep it all
Yes.
organized? Yeah.
Yes, you
Perfect.
can. So most MICs and administrators can be submitted to through Finmo. They're all there. If there's somebody who's not there, but like if they're able to receive applications through Finmo, but they're not on the list yet, you can contact Finmo and get them signed up. Some administrators do not have the ability to receive credit reports. They can receive the deal, but you have to download the credit report and send them. And then private individuals, you still want to do all of your disclosure forms through Finmo. You want to put your deal together through Finmo because that's where you're going to get all of your disclosure documents to the client, as well as your Form 1 for the investor to sign. So all of that's going to be done through Finmo.
Right. So perfect. That's what I needed to know. Excellent. Thank you.
No problem.